Gold has climbed hard, and the same voices who missed the entire move are still leaning into the camera to tell you it is time to sell. Think about how strange that is. A thing goes up and up and up, and the louder it climbs, the more insistent they get that you should let it go. That is not analysis. That is a story someone needs you to believe. So let me answer the question in the title before I do anything else, because you did not click this to be teased. Yes, gold has had a big run. And yes, the financial channels are still saying sell. But here is the honest read, and it is the whole video in one sentence. The biggest, quietest, most patient money on the planet is doing the exact opposite of what they are telling you to do. While the retiree gets a wagging finger, the central banks of the world have been backing up the truck. And here is the concrete piece that should stop you cold. Gold recently passed the euro to become the second largest reserve asset held by central banks anywhere on Earth, sitting behind only the US dollar itself. Read that again. Not a fringe asset, not a relic. The number two thing that the institutions who literally issue money choose to hold. They did not put out a press release begging you to join them. They just kept buying. I have spent a long time in the gold and silver world, sitting across the table from people trying to protect what they spent a lifetime earning, and I have watched this pattern play out more than once. The move happens, the big money accumulates in near silence, and the mainstream commentary stays negative right through it, because being negative on the way up is how you sound sophisticated while being wrong. So before you do anything you cannot undo, let me show you who is actually buying, why they cannot stop, and what it means for the account you have been quietly building. Picture a retired shop teacher in southern Indiana. Call him a man who spent 40 years teaching kids to measure twice and cut once, who never chased a hot tip in his life, who saved steadily and did everything the careful way. He turns on the television and hears a well-dressed analyst say gold has run too far. Take your profits, get back into the safe stuff. And something in his gut tightens because he cannot square the advice with what he can see with his own eyes. That knot in his stomach is not weakness. It is his instincts working correctly. Because the people who issue the world's currencies are not selling, they are buying. And you deserve to know why that gap exists. Let me explain the mechanism, because this is where it gets interesting. For decades, gold traded a certain way. When real interest rates rose, gold was supposed to fall, because gold pays you nothing, and a rising yield made cash look more attractive by comparison. That relationship was so reliable that a whole generation of traders built their models on it. And then, recently, it broke. Real yield stayed high, and gold climbed anyway. The old model simply stopped working. When a relationship that dependable snaps, it is not noise. It means a new and far more powerful buyer has walked into the market and taken over the pricing. That new buyer is not a hedge fund, and it is not the retail crowd. It is the official sector, the central banks. And unlike a trader, a central bank does not care what the screen printed this morning. It is not trying to scalp a quick move. It is repositioning the foundation of its national reserves for a decade, and it will keep buying into strength, into weakness, into whatever the price does, because its reasons have nothing to do with the daily tick. That is why the correlation broke. A price-insensitive buyer arrived, and a price-insensitive buyer changes everything. Now, why did they start? Here is the part the financial channels really do not want to dwell on. A few years back, one of the largest economies on Earth had a big slice of its reserves frozen essentially overnight, locked up by the countries that controlled the financial plumbing. And every finance minister and central banker in the world watched it happen and drew the same quiet conclusion. Reserves you hold as an entry in someone else's system can be switched off if you fall out of favor. Gold sitting in your own vault cannot be. It has no counterparty. It cannot be frozen, canceled, or inflated away by a decision made in another capital. That single lesson lit a fire under official gold buying that has not gone out. And that brings me to something happening right now that deserves your full attention, because it is the strongest reason you should at least understand your options before you dismiss all this. For a stretch there, central banks bought gold at a pace the world had not seen in modern history, north of 1,000 tons a year, 3 years running, roughly double what they had been buying the decade before. That buying has cooled off and gotten choppy lately, some of them even trimming, and that is honest, and I want you to hear it. But the direction of travel has not changed. They diversified toward gold and away from paper promises, and they are not unwinding it. When the buyers of last resort make a generational shift like that, the retiree who notices early is not being reckless. He is being observant. Let me pause right here, because this is the exact moment this matters for you personally. If you are a saver with $100,000 or more sitting in a 401k or an IRA, watching the very institutions that manage nations quietly rotate a slice of their wealth in a hard metal, it is fair to ask whether you have that same option. And you do. That is why our family put together the free Retirement Wealth Protection Guide. It walks you, in plain language, through how everyday American retirees can diversify a portion of the retirement account they already have into physical gold and silver, without taxes and without penalties, using what is called a self-directed precious metals IRA. There is one quiet structural fact worth pausing on here, and it is the one that keeps me up at night more than the gold story. The world has run a silver shortfall for several straight years now, demand outrunning fresh supply, steadily drawing down the metals sitting in above-ground vaults. This guide is not just for insiders or the wealthy. If you have $100,000 or more in any retirement account, this is for you. If you are watching this on your TV, just scan the QR code on your screen. If you are on your phone or your computer, go to readfamilyguide.com. From our family to yours, no obligation, nothing to buy. Now let me come back to the story, because I promised you the deeper mechanics, and this is where it gets strange. Ask yourself why the financial media is structurally built to tell you to sell. Follow who profits. The big trading desks and the brokerage machine make their living on your activity, on the churn, on you buying and selling and buying again. A retiree who calmly holds physical metal for 10 years is a terrible customer. He generates almost no fees. But a nervous holder who dumps his position because a man on television spooked him and then buys back in 3 months later when it is fashionable again, that man is a revenue stream. The advice to sell into strength is not a conspiracy in a darkroom. It is simply a business model, and you are meant to be the product. And that is not even the biggest piece. Consider the professional money managers, the ones running the pensions and the big funds. Most of them own little to no gold, because for years their careers rewarded them for owning stocks and bonds, and nothing weird. Admitting now that gold has become the world's #2 reserve asset would mean admitting they have been underweight the whole way up. It is far more comfortable for them to call it a bubble than to explain to their clients why they missed it. So the establishment has a powerful incentive to keep the story negative, right up until the moment it becomes impossible to deny. I want to be straight with you, because a guide who only ever tells you the upside has not earned your trust. This is a case, not a guarantee, and it is not personal financial advice. Gold does not go up in a straight line, and anyone who tells you it does is selling you something. It has had brutal pullbacks inside its biggest bull markets. There was a stretch in the middle of the great run of the 1970s where gold got cut nearly in half, terrifying everyone who owned it, before it went on to multiply many times over from there. More recently, a mere hint that the Fed might slow its support was enough to knock gold down painfully in a short window, even though nothing about the long-term story had actually changed. So I am not going to insult you by pretending I know what the price does next month. I do not. What I can tell you is what the largest holders on Earth are doing with their own reserves, and that is a fact, not a forecast. Here is another honest wrinkle you should hold in your mind. A lot of gold's recent strength has ridden on fear, and some of that fear premium can come out fast. When tensions in a critical region ease and it looks like a conflict might be contained, the safe haven bid that had been baked into the price bleeds out, and gold can slip, even when the deeper story is intact. We have seen exactly that kind of de-escalation take some of the war premium back out of the metal recently. That is normal. A safe haven premium gets priced in when danger looks likely, and it drains away when things calm down. But notice something crucial. The central bank buying is not a fear trade. It is a structural trade. It does not evaporate when a headline improves, because it was never about this month's headline. That is the difference between the froth on top and the foundation underneath. Now, watch what happens when you zoom out past the froth. There is a ratio worth knowing. The price of the Dow measured in ounces of gold. At the roaring stock mania around the turn of the millennium, it took an enormous number of gold ounces to buy the Dow, because stocks were beloved and gold was despised. At the gold peak of 1980, that ratio collapsed toward 1, meaning an ounce of gold and the entire Dow were nearly worth the same. These are not predictions. They are the actual swings of history, and they tell you that the pendulum between paper assets and hard assets travels much farther than anyone believes possible while they are living through the middle of it. Let me hand you a piece of history that will make your skin prickle, because it shows what governments actually do with gold when they have to. Back in the 1930s, in the depths of a crisis, the United States government made it illegal for ordinary citizens to own most gold, forced them to hand it in, and then turned around and revalued the price of gold higher by decree, by well over half, essentially overnight. The people who had dutifully surrendered their metal got the old price. The government captured the new one. I am not telling you that specific thing is about to repeat. I am telling you that when the pressure gets severe enough, the value of gold can be reset by policy in a single stroke, and it is always reset upward, never down. Governments understand exactly what gold is. It is you they would prefer to keep in the dark. And if you want to see what listening to the sell advice actually costs, history hands you a perfect and painful example. There was a moment, a couple of decades back, when a major Western government decided gold was a dead, embarrassing relic and chose to sell off a large chunk of its national gold reserves. It even announced the sales in advance, which told the whole market exactly where and when the selling was coming. And it sold almost to the month into the lowest prices gold would see for a generation, right before one of the greatest bull markets in the history of the metal. The price it dumped at became a nickname for the exact bottom. That is what happens when a serious institution swallows the conventional wisdom that gold has had its day. They sold the family silver at the worst possible moment, and gold went on to multiply many times over from there. The lesson is not that governments are stupid. It is that even the most powerful players get shaken out when the story turns negative enough, and the ones who capitulate at the bottom are the ones who were most sure they were being sensible. That is the trap the sell advice is quietly walking you toward. It always feels sensible. It always sounds sophisticated. Taking your profits, trimming your winner, getting back to the safe stuff, it all wears the costume of prudence. But prudence measured against what? Against a dollar that buys less every year? Against a paper reserve that can be frozen? The retiree who sells his metal because a confident voice told him to is doing the exact same thing the government did when it dumped its gold at the low. He is calling the bottom of a bull market prudence. Think about what all of this does to the sell advice you are hearing. The institutions with the deepest research budgets and the most at stake, the ones who could reset the price with a signature, are accumulating. The commentators with no skin in the game are telling you to fold. When the house is buying and the floor announcer is telling you to cash out, you might want to ask who the announcer works for. Let me bring this all the way home, back to that retired shop teacher in Indiana with the knot in his stomach. His instinct was right, and here is what I would want him to understand. This is not really a story about getting rich. It is a story about not being the one left holding only the paper when the rules quietly change underneath him. The whole point of noticing what the central banks are doing is not to gamble. It is to make sure that a shakeout, or a currency that slowly loses its purchasing power, or a policy reset made in a marble building he will never enter, cannot erase what he spent 40 years building. Protection first. Everything else is secondary. So let me give you the practical principle, the one thing to actually do with what you own, because I do not want to leave you with only a feeling. If you decide a slice of hard metal belongs in your retirement, own the real thing, the physical metal, not a paper claim on metal that a dozen other people also think they own. There are far more paper claims floating around than there is deliverable metal to satisfy them, and paper is exactly the thing that fails you in the moment you need it most. And size your position so that you are never forced to sell it at the worst possible time. The people who get hurt are almost never the ones who owned gold. They are the ones who were forced by circumstance to sell it into a panic. Own it in a form no one can freeze, and hold it in a way no one can shake you out of. Here is the recognition I want to leave you with, and I am going to say it plainly because it is the heart of the whole thing. The smart money has already moved. The central banks have already repositioned. They did it quietly, over years, while the financial channels called it a bubble. The crowd, the pension funds, the folks who wait for permission from a headline, they have not caught up yet. And by the time this is the obvious, comfortable, everyone agrees trade that leads the evening news and every advisor suddenly recommends it, the patient part of the move will already be behind us. There is no announcement when you are early. There is only the quiet gap between what the biggest money is doing and what the loudest voices are saying. Right now, that gap is wide open. That is the opportunity, and it does not stay open forever. Which brings me to the last thing I want to share, and then I will let you go. That same free retirement wealth protection guide is not only about protecting what you have today, it is about the legacy underneath it, the wealth you intend to pass to your children and your grandchildren, the part of your life's work that is supposed to outlast you. And for those of you who watch all the way to the end here, with $100,000 or more in a retirement account, we also offer a free, no pressure, one-on-one educational web conference. Just mention that you watched this full video. There is no fake deadline, and I will not invent one. The honest why now is simpler and truer than any countdown clock. The window where a decision like this is still calm, cheap, and easy to reverse is precisely the window when nothing feels urgent, which is exactly where we are right now. If you are watching on your TV, scan the QR code on your screen. If you are on your phone or computer, go to readfamilyguide.com. From our family to yours. So let me end where we started. Gold has climbed hard, and they are still telling you to sell. But the ones telling you to sell do not own it, and the ones who own the world's reserves are not selling. Gold has quietly become the second largest reserve asset held by central banks on Earth, and they built that position quietly, without asking your permission and without a single headline announcing it. The retired teacher in Indiana felt in his gut that the advice did not add up. His gut was right. The question is not whether gold has gone up. It has. The question is whether you are going to listen to the announcer or watch what the house is actually doing with its own money. Watch the house.